Hey everyone, it's Finance Fix News. Let's be real, who doesn't love passive income? That's why today, we're diving headfirst into the world of dividend stocks. These are the powerhouses of the stock market, the companies that pay you just to own a piece of them. Forget slaving away at a 9 to 5. Dividend stocks are your ticket to building wealth while you sleep, travel, or even just binge watch your favorite shows. And the best part? We're focusing on the top performers for 2024, the companies poised for steady growth and consistent payouts. Now remember, I'm not a financial advisor, and this isn't financial advice. This is all about giving you the knowledge to make smart decisions with your money. Investing always comes with risks, but with the right strategy, you can build a portfolio that generates passive income for years to come. So, buckle up, grab your notebooks, and let's get started. First up is Exxon Mobil, ticker symbol XOM. This isn't just some random company, we're talking about an energy giant. They're fueling your car, heating your home, and potentially your bank account with dividends. Oil prices fluctuate, but Exxon Mobil weathers every storm. Robust cash flows mean consistent dividends. Their dividend yield is around 3.3%. They're investing heavily in renewable energy projects. For stability and growth, Exxon Mobil is a solid bet. Now, let's talk numbers. A 3.3% dividend yield might not sound like much, but remember, that's on top of any potential stock price appreciation. With a 3.3% yield, you'd be looking at around $330 in passive income per year. That's the power of compounding in action. The stock market is unpredictable, and there are no guarantees. So if you're looking for steady dividends and potential growth, Exxon Mobil is worth considering. Next up, we're diving into the world of healthcare with Johnson & Johnson, ticker symbol J&J. This isn't just another company, we're talking about a healthcare titan. They're the name behind some of the most trusted brands in the world. Johnson & Johnson has a moat around their business. It's incredibly difficult for competitors to chip away at their market share. Johnson & Johnson has consistently paid and increased its dividends for over 60 years. 6 decades of putting cash back into the pockets of their shareholders. Now, let's talk about why Johnson & Johnson is considered a dividend aristocrat. This isn't a title they hand out to just any company. To be a dividend aristocrat, you need to have increased your dividend payments for at least 25 consecutive years. Johnson & Johnson has more than doubled that, with over 60 years of dividend growth. That tells you everything you need to know about their commitment to their shareholders. So, if you're looking for stability and consistent dividend growth, Johnson & Johnson is a no-brainer. Moving on to a sector that's become a necessity, telecommunications. Verizon Communications, ticker symbol VZ, is a telecom giant. How many people you know don't have a cell phone these days? Verizon is a dominant force in wireless services. They're shaping the future of communication. With a dividend yield over 6.5%, Verizon is ideal for income-focused investors. Their payout ratio is a comfortable 50%. Backed by strong cash flow, Verizon is a high-yield investment to remember. Why Verizon over other telecom players? Verizon adapts and thrives in a rapidly evolving industry. They're not just resting on their laurels. Investing in 5G and fiber optics keeps them ahead. It's about finding companies with growth and profitability. Verizon checks all the boxes: strong history of dividends and a clear vision, reliable income stream and growth potential. Now let's dive into a company that might raise a few eyebrows, but trust me, it's worth your attention. We're talking about Altria Group, ticker symbol MO. You probably know them best for their tobacco products, specifically Marlboro cigarettes. Altria has consistently defied expectations and delivered impressive dividends. Altria boasts a dividend yield of around 8.3%. They're diversifying into the rapidly growing cannabis space. Investing in Altria comes with risk. The tobacco industry faces declining smoking rates and increased regulation. Altria is taking proactive steps to mitigate these challenges. They're investing in smoke-free products like IQOS and ON. Altria has a strong track record of consistent dividend payments. If you're comfortable with volatility and seek high-yield opportunities, consider Altria. Remember, diversification is key. Alright, let's talk about Kraft Heinz, ticker symbol KHC. Who hasn't grown up with Heinz ketchup or Kraft mac and cheese? These brands are kitchen staples. Investing in Kraft Heinz offers stability and familiarity. Kraft Heinz is a huge company with competition. They've streamlined operations to cut costs, but they still dominate the food industry. Their brand recognition and loyal customer base are unparalleled. Kraft Heinz is adapting with new plant-based and organic options. Now let's talk dividends, because that's what we're all here for, right? Kraft Heinz offers a respectable dividend yield of approximately 5%. Consistency and reliability are key when it comes to dividend investing, and Kraft Heinz delivers on both fronts. They have a solid track record of consistent dividend payments. Their focus on innovation ensures they stay ahead of the curve. Some investors might be put off by Kraft Heinz's recent struggles, but they have a strong management team and iconic brands. With a 5% dividend yield, you're getting paid while you wait. Alright, let's talk about a sector that often gets overlooked but is a cornerstone of any good dividend portfolio: utilities. Specifically, we're diving into Duke Energy, ticker symbol Duke. You see, Duke provides an absolutely essential service: electricity. People need power, no matter what's happening in the economy. This translates into a predictable revenue stream for Duke, and more importantly for us as investors, consistent dividends. Now I know what you're thinking, utilities, that sounds boring. But boring can be beautiful, especially when it comes to building long-term wealth. Duke Energy is currently offering a dividend yield of around 4.3%, which is nothing to sneeze at. And the best part? Duke isn't just sitting back, raking in profits from their existing infrastructure. They're investing heavily in renewable energy sources like solar and wind. This positions them for sustainable growth in a world that's rapidly shifting towards cleaner energy. Now I always say don't put all your eggs in one basket, and that applies to dividend investing too. Diversification is key, and Duke Energy provides that nice balance between stability and growth potential. They're not just riding the coattails of an existing market, they're actively shaping the future of energy. This forward-thinking approach is exactly what I look for in a long-term investment. And let's not forget about their commitment to shareholders. Duke has a solid track record of dividend payments and increases. They understand that as investors, we're in this for the long haul, and they're committed to delivering value. So, if you're looking for a reliable dividend payer with a bright future, Duke Energy deserves a spot on your watch list. Remember, slow and steady wins the race, and Duke is in it for the long run. Now let's talk about a sector that's not just financially sound, it's literally keeping people alive, the healthcare industry. And within this massive market, Medtronic, ticker symbol MDT, is a true powerhouse. Medtronic is a global leader in medical devices from pacemakers to insulin pumps. They're improving and extending lives every single day. And as an investor, that's a company I can feel good about supporting. But this isn't about warm and fuzzy feelings, it's about cold, hard cash. And Medtronic delivers on that front too. They're currently offering a dividend yield of around 3%, which might not seem huge, but hear me out. Many analysts believe Medtronic is undervalued right now. This means you could be buying into a solid company at a discount, potentially setting yourself up for significant long-term gains on top of those steady dividends. See, Medtronic has faced some headwinds recently, which has put pressure on their stock price. But you know what they say, buy when there's blood in the streets. And while I'm not advocating for anything drastic, this could be a great opportunity to get in on a fundamentally strong company at a bargain. Plus, the demand for medical devices is only going to increase as the global population ages. Medtronic is well positioned to capitalize on this trend, with a strong pipeline of innovative products and a global reach. And let's not forget about their commitment to returning value to shareholders. Medtronic has a long history of dividend payments and increases. They understand that as investors, we're in this for the long haul, and they're committed to delivering. So if you're looking for a combination of value, growth potential, and a steady stream of dividends, Medtronic is definitely worth a closer look. Remember, healthcare is a recession-resistant sector, and Medtronic is a leader in the space. Alright, let's talk about a concept I absolutely love, monthly passive income. And one of the best ways to achieve that is through REITs, real estate investment trusts. Specifically, we're diving into Realty Income, ticker symbol O. Realty Income is a giant in the REIT space, owning and managing a massive portfolio of commercial properties. Think of everything from your local grocery store to pharmacies and even gyms. Now here's what makes Realty Income so special. They pay dividends monthly. That's right, every single month you get a check in the mail, or more likely, a deposit straight into your brokerage account. And it's not just about the frequency, it's about the consistency. Realty Income has a long and impressive track record of dividend payments and increases. They've been doing this for decades through multiple economic cycles. Currently, Realty Income is offering a juicy dividend yield of around 4.7%, which is significantly higher than your average S&P 500 company. And remember, those dividends are rolling in every single month. Now, some people might be hesitant about REITs, especially with interest rates on the rise, but here's the thing. Realty Income focuses on properties with long-term leases, which provides a level of stability even in a fluctuating interest rate environment. Plus, they've got a diversified portfolio across different industries and geographic locations, mitigating risk. This isn't some fly-by-night operation. Realty Income is a blue-chip REIT with a proven track record. So, if you're looking to build a truly passive income stream, one that pays you like clockwork every single month, Realty Income deserves a spot on your watch list. Remember, the magic of compounding works best when you're reinvesting those dividends, and with Realty Income, you're getting more opportunities to do just that. Alright, let's shift gears and talk about a company that's all about motion and control. Parker Hannifin, ticker symbol PH. Now, you might not have a Parker Hannifin product sitting on your kitchen counter, but trust me, they're everywhere behind the scenes. From aerospace to industrial machinery, this company makes the components that keep things moving. What really excites me about Parker Hannifin is their focus on industrial automation. This sector is booming, and Parker Hannifin is right in the thick of it, developing cutting-edge technologies that are shaping the future of manufacturing. We're talking about smart factories, robotics, the whole 9 yards. And the best part, this growth directly translates into value for us as investors. As Parker Hannifin expands its reach in the automation market, its earnings potential skyrockets. And that means potentially higher dividends down the line. So even though the current yield might seem modest, remember that we're playing the long game here. Now I know what you're thinking. The dividend yield is only around 1.5%. Why should I even bother? And that's a fair point. But remember, dividend investing isn't just about chasing the highest yield. It's about finding companies with a solid track record of dividend growth. And that's where Parker Hannifin shines. They've consistently increased their dividend for over 60 years. That's right, 6 decades of putting cash back into investors' pockets. That tells me they're committed to rewarding shareholders and have the financial strength to do so. Plus, with their strong position in a high-growth market, I wouldn't be surprised to see those dividend increases accelerate in the coming years. Look, I'm all about that passive income, and Parker-Hannifin might not be the flashiest dividend stock out there. But if you're looking for a company with a proven track record, a bright future, and a commitment to dividend growth, Parker-Hannifin is definitely worth a closer look. Alright, let's talk about a company that needs no introduction, 3M, ticker symbol MMM. You know them, you love them, you probably have a drawer full of their post-it notes right now. But 3M is so much more than just office supplies. They're a global powerhouse with a diverse portfolio of products spanning multiple industries. We're talking healthcare, transportation, electronics, you name it, 3M probably has a hand in it. This diversification is key, especially during uncertain economic times. Even if one sector is struggling, 3M has others to fall back on, providing a level of stability that's crucial for dividend investors. And let's not forget about their incredible track record of innovation. 3M is constantly developing new products and technologies, ensuring they stay ahead of the curve. This commitment to R&D is what's allowed them to remain a leader in their field for over a century. Now, I'm not going to sugarcoat it, 3M has faced some challenges recently. Litigation and supply chain disruptions have put a dent in their earnings. But here's the thing, 3M is a survivor. They've weathered countless storms over their 100-year history, and I'm confident they'll bounce back from this one too. Plus, their dividend remains rock solid. With a yield of around 3.5% and a 65-year history of dividend increases, 3M is a dividend aristocrat through and through. That means they've consistently increased their dividend for over 6 decades, a testament to their financial strength and commitment to shareholders. Look, I get it. Past performance doesn't guarantee future results. But when I see a company with a century of success, a diversified portfolio, a commitment to innovation, and a rock-solid dividend, I'm not going to bet against them. 3M is a company built to last, and I believe they'll continue to reward patient investors for years to come. And there you have it, 10 of the best dividend stocks for 2024 that could provide you with steady, reliable income. We covered everything from energy giants like Exxon Mobil to industrial automation leaders like Parker-Hannifin. Remember, building a successful dividend portfolio is all about diversification and finding companies with a strong track record of dividend growth and a bright future. If you found this video helpful, please don't forget to smash that like button and share it with your fellow investors. And as always, hit subscribe for more insights from Finance Fix News. Thank you. Until next time, keep investing wisely and watch your wealth grow.